streaming. Welcome, folks, to the September live video. As usual, I'm just trying to test sound, so if you could hear me, you can hear me without any issues, just please type something on the chat. Okay, we have sound and we have video. Even though it's a little dark for my taste, I always move across my office looking for little spaces where I can do the live video without being interrupted. So let's wait just a few more minutes for more people to join and we'll start. Okay, let's start. Time is of the essence, and we are going to have a recording of this particular presentation later on for those of you that will come later, and also because it's a YouTube stream, no? So even if you come late, you can start watching from the beginning. That's the beauty of Google. Now you don't have to join midway through the presentation, halfway through the presentation. You can just start watching it from the beginning. So let's start. Welcome to the September live video. I've been trying to be really good doing this at least once a month. We can do it as frequent as you want, but I guess once a month is more than enough to discuss what is going on in the market and see my expectation and what is happening in general with volatility. So let's start with before I start, just a reminder that you can ask me questions at any time. Just type the questions and I'll come back to them and answer them. So you can interrupt me at any time if you wish. So let's start with the NDLA. So NDLA was very slow during July, like basically no signals during July. And suddenly during August, of course, because we have that drop in early August, then the NDLAs started to wake up and they have performed decently. I'll say that they have decent performance. We got a string of failures at the beginning when we tried to trade it, but the good thing about having a statistical edge is that we got 2 successes last week, and one of them was partial because I was so eager to collect the money that I didn't allow the trade to finish. No, and even with that partial profit, we covered all the losses and we got some money left. So that's the advantage of doing this kind of system with a positive edge, where the whole point is that yes, we are not going to win every trade, but the winners that we have will win more than enough to cover losses and hopefully to get us way ahead. So far I am very pleased with the performance, and just a few comments about them. One of it is that, okay, so I have questions. Michael is asking me if the NDLA is a primary indicator of when to trade. Well, Michael, I trade several books. I have my own book that I trade, and I that one is private. No, I don't share it with anyone. But the NDLA is one of those things that I decide to share with the Gamma Optimizer members. And yes, in the Gamma Optimizer, I will say that that's kind of the main driver of trades, and it does apply only to SPX. And it's not just because I am picky about SPX. It's just because the inputs that we need for the neural nets are conveniently available for SPX. I have discussed these inputs before, but in particular, 2 of the inputs, which are VIX, the VIX index, VIX 9D, the 9-day implied volatility, and VVIX, which is the volatility of volatility. So those indexes are widely available for SPX, but not for anyone else. No? So we don't have a VIX 9D for like Google, or a VIX 9D for Apple, or a VVIX for Google, so far and so on. Yeah, eventually, if we could develop some equivalence, then maybe we could apply some of the strategies of the NDLA to arbitrary symbols. But right now, they only apply to SPX. Okay, and also, just to add, even though the NDLA is the main thing we trade, I trade all other stuff now. I do the trades by request, and once in a blue moon I post a downside trade like the one today, which is a lotto. No, it's a lottery type of trade, which is my preferred way of playing downside, because this is a bull market, and this market just goes up, as you can see. It keeps going up and up. So playing downside has to be done very speculative and small size, and with things that they believe are tremendous gains if downside actually materializes. So I do these kind of things. Okay, so coming back to NDLAs, the NDLA 2.0 has been better than NDLA Classic, and you can see the full precision for NDLA Classic is around 55%, and which is basically the same performance as the naive. So this one has me really disappointed, because if you remember, the naive column means the null hypothesis or the control group. It means that 1% moves that happen naturally. It is a naive strategy in the sense that we assume that the 1% move up will happen every time. So if following that strategy in the last month, you will have been successful 55% of the time. And the NDLA marginally improve over it. So that's not good for NDLA Classic. It's marginally improving over the naive. While the NDLA 2.0 has a much better precision. I don't post this table on the tool. I know that I need to add it. It's just I don't find the space where to add this table. But those are the stats. I publish it once in a blue moon, and I try to give updates. NDLA 2 has way more precision, 63% over the 55 naive. So it is an improvement. I think it's a meaningful improvement over the naive. So I am kind of happy with NDLA 2. And it is beating what it is. NDLA 2, signals from NDLA 2 are beating the naive strategy and the classic strategy. So for those of you that enter these two signals here, I think you're doing really well. Imagine we are actually close above the target from yesterday, from the day from yesterday. So I didn't play that signal because I am only playing with both of the nets agree, but kudos to those of you that play that signal. And there is another signal for 3030. I don't know if that one will work, but but NDLA 2 seems to be having much better results at this point. Okay, more questions. Michael, do you use any EW charts for trading? I'm showing my code screen. Yes, I use this thing that you're seeing here. For those of you that know me well, I use RStudio. RStudio is kind of my command center. I write pretty much everything I do in R, and I use it to compute all sorts of things. Pretty much everything that you see on my tools is written actually in R, and I just create a web interface around that. But it's using all of the code that I have here. So I don't mind. I mean, this is just a normal cbrent function to find roots of an arbitrary function. So it's just this is a C++ simple thing. It's kind of it's a classic. You can find it in any place. So I'm not showing any secret code here. And in terms of the question of if I trade the Elliott wave charts for trading, well, in a sense, yes, because remember the NDLA is only gives us signals for 1 week ahead. So it's good, it's fun when we get the signals. It's fun when we play it and I make money. But at the same time, following the experts like Avi or Zach or Garrett is actually really good, because they do have a longer term view of where the market is going. And that longer term view, I appreciate it, and it also informs my trading. And I also generate some trades based on their views. But in terms of Elliott wave theory, I just defer to the experts. No, I follow their targets. I am not an Elliott wave person, and I am honest. Everyone that knows me knows that I have no idea about Elliott wave. I have a very basic command of the most essential vocabulary. I know what a wave tree is, and I also know what a B wave is, and I think that that's pretty much the extent of my expertise in Elliott wave. Okay, so that was a good question. I have a question. What is the difference between NDLA 1 and NDLA 2? And I was saving a slide for it, but I'm going to put it right here. So we used to have, just going back a little bit in history, we used to have something called the original net. It was called DLA, the digital learning algorithm. And then I did a complete redesign and a full redesign of the net, and that was the NDLA. The N means the new DLA. And then the NDLA works really well, but we needed to retrain it. We needed to incorporate more recent data into it, because I think the data was like 2017, I guess that was the data that NDLA uses. So NDLA 2.0 was born. NDLA 2.0 uses more recent data. I think it's trained until July 2018. And also, it has a minor difference in the structure. I just kind of simplify a little bit the structure of the net, which reduced the total amount of neurons, if you wish. So the complexity of the net was reduced a little bit, just to save me in training time, and inference time also. But the effect is very little to be understandable. But in general, both of them are very similar. They are both binary classifiers. So it's not like NDLA 2.0 is a major departure of NDLA Classic. Okay, so that was the NDLA. I wanted to mention that right now I only trade positive signals from the NDLA, because that's all of the work that I did for this, and the naive strategy are based on positive signals, and the H is fantastic, and you have seen firsthand that the H is really good. But I noticed that some of you really like to trade the negative signals. I, on the other hand, I cannot bring myself to trade a negative signal. And even though looking at the variance center, if we look at the negative signals, you can see that the long-term performance is actually good, 75%, 80%, 82%, 83%. So yes, negative signals seems to have a really good, like higher than the positive signals, but the thing is, because you're doing the opposite, then H seems to be against you. If you compute the H of this, let's assume 80%. That means that you have to get at least 1.0 credit for the vertical that you're selling, And I will say that that's really hard. I mean, when this thing is at 80%, it's really hard to get the 1.0. You can get it really nice. Like in the last 20 sessions, the negative performance, for instance, of the Classic has been 50%. So just to break even, if you were doing negative trades, you will have to be able to get at least 2.5 for the spread. I mean, and right now the spread costs 150. So I don't know. I don't see statistical edge for me at this point. I know that you guys have a very sophisticated set of rules based on the raw data that I post frequently, and I truly enjoy seeing you guys dig into the data. But there is something about short gamma trades that it doesn't align with me. I mean, short gamma, I guess is the level of stress is substantially higher than long gamma. When I go into an NDLA trade, I pay my $1 or $1.50 or $2, and I'm happy. But if I am on the hook for 3 or for 3.50 in this case, then I'm not that happy. It is different, because the risk reward seems to swap, and that's what I don't like about negative trades. So, okay, another question from Michael: if I always trade the spreads? Yes, I always trade the spreads, in particular because SPX options, which is what I exclusively trade, I do as a personal, my personal system is all XPX. And SPX options, if you notice, are incredibly expensive. I mean, it's just the notional is 3,000. No? When you have a notional of 3,000, then the options are outrageously expensive. So there are no ways to trade the options by themselves. So I go for spreads. And another reason I go for spreads is, in the case of NDLA, is that I am actually using them as binary options, replication of binary options. And this is a whole, so they have delta and they have gamma. So if prices move, so you have a second order, gamma is the second order effect of the move. But with binary options, gamma is the first order effect. And you can see that. You can see when you have a spread and if the move is in your direction, the spread moves fantastically fast. As long as it's long gamma, it moves incredibly fast, and that's what I like. I like to have this first order behavior of gamma. So I want convexity to appear right away, and that's what I like spreads. Jeffrey says, you were selling the spread, but is there a disadvantage to buying a put spread? Well, it's the same thing. I mean, Jeffrey, so remember, in spreads, it really doesn't matter if they are done with puts or calls. No, you only have two types of spreads. You only have bullish spreads or bearish spreads. No, that's the only two types of vertical spreads that there exist, of verticals. So you either make money when the thing goes up, or you either make money when the thing comes down. In the case of the NDLA, well, the easiest trade is just the mirror image of the trade we do. So we are selling the call spread, but yes, you can buy the put spread as well. But you notice that if you buy the put spread, it will cost you 350. No, so the complement from 5. No? So it is 150 right now, so it's 350 to 5. So it costs you 350 or even more. So it's kind of expensive for my taste. That's what I mean when playing the negative signal. But going for the long-term historical, if you notice all this long-term historical, it seems that it's a good, it performs well, but I think it's not my style, I guess, is the right way to put it. Okay, let's move along, because I like to keep this short. So look at the current positions. Okay, let's look at the current positions. And you will notice that there are no positions open. I only track in these two positions, which I closed officially long ago. So the two positions that you see here at the beginning are only tracking. I am just tracking them because I know some members still have the positions open. If you notice, they were closed around here. One of them actually made money, the other one didn't make that much money, but so I'm just keeping them for tracking. So so we don't have any positions open. However, we did close two NDLA trades right here, and they performed really well. I'm very happy with the performance, 150% and 108%, even though I know I closed it really early. I know some of you guys got $5 for it. I mean, I envy you. But I really wanted to bring the performance of the account over 100%, and that's what we are doing right now. We have 108% performance since we have been tracking this trade since late March, when we started doing NDLA trades exclusively. So no positions. Today you notice that I opened a lotto for end of October. There is a reason that I opened the lotto, and I'll lead you in the secret in a little bit. But I mean, it's only 20 cents. No, how come? I mean, at 20 cents, I'll buy it. I'll buy anything that is basically they are giving me away for free, this thing, and it's 20 cents for $5. I love the risk reward of this thing. So it must be that it says that my text is small and fuzzy. It must be my internet is having issues. Sorry about that, guys. Must be something happening with the bandwidth of the transmission, but hopefully it restores itself better. So we have a end of the world lotto for end of October at 20 cents. And why did I do it? Because I think that we are really close to at least a local top in SPX. And one of the things that gives me the hint is ambiguity. Ambiguity has been increasing consistently for the last several sessions. And also I don't like realized variance. Realized variance has been behaving really weird, as you can see here. You can see the shape of realized variance is very interesting, and it shows that just the liquidity is not quite there. So there is some issues, some liquidity issues, and it's surprising because the market is going up, and it's surprising to see liquidity issues with the market going up. It could be that traders are still on vacation, but I don't know, it could be something else going on. So spending $20 just to fish for that top, I think it's a decent play. I think it can work. Okay, so what else? Let's see. Well, the two NDLA trades, and that's what we have in current positions. In terms of volatility, let's look at volatility. You know that I look at two types of volatility. I look at realized variance and implied volatility. So realized variance for the last 20 days has been 15.9, 16%. So it's almost no change since last time we did this video. It's basically the same. So longer term, the market has been kind of volatile, not that much. For those of you with long memories, you'll notice that this value looks almost normal. The market has been around 16% historically. So realized variance is not that far from this historical means. The variance for the last 5 sessions for the last week is 6.33, which is substantially lower than it used to be back in August. In August, this thing was like 29%. We had that mini correction, and it was really high. So clearly, the market has been boring the past week. And finally, we have VIX at 14, which is exactly the same. I mean, 14 is still at, I think, below the longer term value. I don't know, I haven't computed the mean in a while, but 14 is kind of decent. So the market is kind of in a position where there doesn't seem to be where option dealers or volatility dealers, they don't seem to be pricing that much of uncertainty into the near future, and the market itself hasn't shown that much uncertainty also with realized action. So this is one of the things that I'm kind of like betting of a reversal of this. I'm kind of like looking for all of these values to increase dramatically as September winds down and October comes in. The expectations, okay, so in expectations, in August I wrote that I expected August to remain range bound. And I guess, I could argue that it was range bound in some way or another. The month of August was really like going down and really going up. At the end, it kind of ended more or less the same. So I could claim some credit, but in general, I was surprised by the mini correction at the beginning. It did happen. For those of you that were here in the June live video, you'll remember that I was expecting summer to be fairly calm, but I guess it wasn't. I guess in August we got a lot of activity, and we closed below the GT level. Now we are above the GT level again, so market seems to be, normalizing a little bit. We have downside into September, October. That was my expectation a month ago. It's still my expectation. It is still my expectation. I'm waiting for more trading volumes to come into the market, and big players to finally start realigning portfolios. So I think there is some volatility that will come into the market. We'll see. September is already halfway through it, and we haven't seen that much volatility yet. But who knows now? There is still some time. We'll see. And in terms of the questions, we got NDLA Classic, and I already explained. And before going to the Q&A, let's just go quickly over the variance center and see what is going on here. So we have negative signals from NDLA Classic and a couple of positives from NDLA 2.0, but today we have a solid negative signal from both of them. So it seems that both nets are not liking that much this area of the market. So maybe we have a little bit more room to the upside, I will say, around this area. If this signal is fulfilled, then the market might tag this, but I doubt that this signal will be fulfilled, but who knows. We also see gamma imbalance. Gamma imbalance continues to be heavily center around 3000. 3000 seems to be, and I guess this is a gamma imbalance from long ago. So 3000 seems to be the key area, and to the right, north of 3000, we really don't have that much imbalance. Below it is when we have lots of support at 2975 and so forth and so on. So there is more interest down than up. That's interesting by itself. Realized variance, it was really ended up subdued today around 10%, but you notice the shape is very, very interesting. There were periods with no liquidity in the market, and I don't like that. So that's kind of what I see in this area in terms of the variance center. No trades for me as usual, because I don't trade negative signals, but I know some of you guys open a negative trades into next week. So finally, I open these two Q&A. So please ask any questions. Remember that there is about 15 seconds, 10 to 15 seconds between you typing the question and me seeing it. So just give me some time if I don't answer. I'll give you guys some time if you want to see something else. But in general, I'm just looking down from this point on, with tentatively looking down, and of course if we have NDLA signals, I'll play them. But I think that positioning for future downside, for higher volatility, could pay really nicely in the near term, probably in a month from now or a couple of months from now. So any questions, folks? Let me see what else I'm missing. I might be missing something here. Let's see. Ambiguity. Let's look at ambiguity. Let's look at a little bit of ambiguity here. Let's compare it really quickly. So ambiguity today closed around 0.15. It has been around 0.17. It came down a little bit today. I don't know why. I'm expecting this to move to the 0.4 area really soon. That's my expectation. So as the market comes a little bit, probably in the next few sessions, ambiguity will keep rising. And once it is 0.3, 0.35, then I think that that's a good moment to start sizing up a juicy downside trade, and something that with a lot of risk control there. But I guess it becomes juicy because every time that the ambiguity has approached 0.4, we have gotten really nice pullbacks. So that's something that I'm keeping an eye. How do you determine? Okay, what specific criteria do you use to make a trade? Well, so I have a thesis now. So my thesis is we are going to have extra volatility in the near term. What does extra volatility mean? It means big moves. So if we are in the 3000 area, for me, a big move is probably 10% down. That's a big move, like a massive move. And 10% down is something that I'm expecting, and 10% down is what brings us to the 2700 area. So right now I'm looking for different ways of playing 10% down. 10%, it could be played in many different ways, but I wanted something really near term, something close to where we are right now, because if it happens, it should happen soon, if it happens at all. No? So that's what I priced the October 31st, 2700 binary put. I price a binary put because I like binary put. So the market with that binary put price at 20 cents, it means that the market is only assigning like 4% probability to that event, but I am assigning a substantially higher probability than 4%. So that's why I'm playing the trade. Now that's one way to play it. And with the NDLA, then we have targets. Now NDLA is even better because it gives us targets and expirations, so it's easy. But in general, you have to develop a feeling for a thesis. Now where something is going in the near term, and with options I like to keep in the near term. I know some of you like to play like 5 years into the future. I prefer to play tops 2 months into the future. And one of the reasons is, first, there is no visibility. I mean, come on, guys, 1 year, 2 years, there is no visibility to, no, there is no real visibility to the event. No? And also, longer term options, leaps, or options with 1 year, 2 years on them, they have no optionality. They have very little optionality, very little convexity. So it's better to play in the near term, and it's easier to develop a feeling. If you are wrong, you're wrong. So if I'm running this trade, I am out of $20, and that's it. No? And I don't mind. But when you have a longer term trade, people have a harder time accepting they are wrong, and you psychologically you tend to carry the position longer, even though it's losing money. So it's kind of a higher resistance to get out of the position, because you always hope that it will come back. So better to stick near term, look for targets, and look for good optionality and cheap positioning. Okay, so I guess the time is up. I appreciate you guys for joining me today. I really enjoyed doing the live videos, and hopefully you learned something new today. As usual, just ask me questions in the room or private messages or post. I am always available to you. Thank you again, and have a great day.